Two Microsoft Income ETFs walk into the exam room. One advertises a 14% distribution yield, the other flashes 31% like a neon casino sign. Both promise to turn Microsoft's stock movement into cash. Both use options instead of simply owning the stock, and both have produced positive results once distributions are included. So this should be an easy contest, right? Bigger yield, bigger income, happier investor. Not so fast. One fund has lost 33% of its launch value while delivering 8% after distributions. The other has lost 48% of its launch value while delivering 29% after distributions. One fund's recent payout is running at 80% of its early average. The other is down to 13%. That is the real autopsy today. Not which ticker prints the loudest percentage, but what each machine had to do to manufacture its cash, what happened to the capital underneath it, and whether the current payout still resembles the one investors originally met. This is MSFY versus MSFO, two ways to squeeze income from the same company with two dramatically different vital sign charts. MSFY is the Curve Yield Premium Strategy Microsoft ETF issued by Curve. It launched on October 31, 2023, has $11 million in assets, and charges an expense ratio of 0.99%. MSFO is the Yield Max MSFT Option Income Strategy ETF, issued by Yield Max. It launched on August 24, 2023, has $99 million in assets, and charges 1%. They live in the same derivative income neighborhood, but neither one is a plain Microsoft stock fund. If you buy ordinary Microsoft shares, you own a direct equity interest in Microsoft and participate in whatever the stock does. These funds take a more complicated route. They use options to create synthetic exposure to Microsoft, then sell calls around that exposure to collect premium. Think of Microsoft as the engine both funds are trying to imitate. Instead of buying the whole car, they assemble a financial simulator using option contracts and park most of the actual cash in government collateral. MSFY reports United States Treasury bills at 96% and the Fidelity Investments Money Market Government Portfolio Class I ticker fix at 2%. Around that collateral, it uses 4 call options and 1 put option that the fund writes for premium income. MSFO reports United States Treasury bills at 101%, a cash offset at 4%, and the First American Government Obligations Fund Class X ticker FGXXX at 3%. Around its collateral, it writes 3 call options for premium income. Those percentages can look strange because option positions, offsets, and collateral accounting do not read like the ingredient label on a normal stock ETF. The important point is that the large treasury positions are not evidence that these are ordinary treasury funds. The treasuries are the financial scaffolding. Microsoft is the economic subject. The options are the machinery. A synthetic covered call strategy generally has 2 jobs. First, options create exposure intended to behave somewhat like owning Microsoft. Second, short call positions sell away part of Microsoft's potential upside in exchange for cash today. The buyer of the call pays the fund a premium for the right to benefit above a specified level during a specified period. The fund receives that premium and can use collected option income to support distributions. That is the bargain in plain English. Rent out part of tomorrow's upside to help fund today's check. When Microsoft rises gently or trades sideways, selling calls may produce useful cash without surrendering an enormous rally. When Microsoft surges through the call's effective strike levels, the fund may not participate fully because some of that upside has already been sold. When Microsoft falls, the premium can soften the impact, but it is a cushion, not a force field. Synthetic exposure can still transmit meaningful losses. Both funds also use actively managed combinations of standardized exchange-traded options and flex options. Flex options allow customized contract terms, but customization does not abolish the core trade-off. The portfolio manager is still deciding how much potential upside to exchange for premium, how the exposure should be rebuilt, and how aggressively the fund should pursue current cash. The strategic difference is therefore not that one fund discovered free income and the other did not. Both are variations on the same economic exchange. The difference is how their implementations have translated that exchange into payout size, payout durability, capital preservation, and total return. MSFY is the smaller and slightly less expensive operation. MSFO is much larger, slightly more expensive, and advertises a much more aggressive income profile. That does not automatically make the smaller fund safer or the larger fund better. Assets under management can matter for market adoption and operating scale, but they do not erase option losses, repair a damaged share price, or guarantee that a distribution will continue. The right comparison is not Microsoft versus Microsoft. It is one options policy versus another with the same corporate star standing behind both curtains. Before we open the charts, this is research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold MSFY, MSFO, or any other fund. ETFs can lose value and option income strategies can behave very differently from the stocks they reference. Verify the current prospectus, distribution history, tax information, holdings, and other official fund documents for yourself, because fund data and strategies can change. Consult a qualified professional who can evaluate your circumstances before making financial decisions. Now for the figure designed to win the thumbnail contest. MSFY carries a headline distribution yield of 14% and pays monthly. That is a high income rate, but the distribution history shows that the cash flow has not remained perfectly level. Its first 4 distributions averaged 25 cents per share. Its latest 4 averaged 20 cents. That means the recent average is lower, but it has retained 80% of the early average. The paycheck has been trimmed rather than evacuated from the building. For an investor planning around cash flow, that distinction matters. A variable distribution should not be treated like a fixed bond coupon or a salary written into an employment contract. Option premium changes with market volatility, contract selection, Microsoft's price path, and the manager's positioning. A monthly schedule tells you when the fund intends to pay. It does not guarantee what the amount will be. MSFO presents the more dramatic proposition, a 31% headline distribution yield paid weekly. At more than 20%, that rate is genuinely extreme. It is also exactly where an investor should slow down rather than speed up. MSFO's first 4 distributions averaged 49 cents per share. Its latest 4 averaged 6 cents. The latest average is only 13% of the early average. That is not a minor wobble. It is a wholesale change in the cash flow experience. Weekly payments may create a satisfying rhythm, but payment frequency and payment strength are different vital signs. Receiving a smaller amount more often does not restore the purchasing power of the earlier amount. This is where headline yield can become a hall of mirrors. The displayed rate is a calculation based on distributions and a current share value. If the share value falls substantially, a distribution can look enormous as a percentage of that smaller base. A high displayed yield can therefore coexist with weaker per-share payments and serious capital deterioration. That does not mean every dollar distributed is fake. Option premiums are real cash flows, and both funds have paid meaningful cash since launch. It means the percentage must be interrogated. How much arrived per share? Is the recent amount rising, stable, or falling? What happened to the capital while those payments arrived? And did the fund earn enough through its full strategy to offset what it distributed? There's also a tax and accounting issue investors must verify in current fund documents. A distribution from an option income ETF is not automatically the same thing as ordinary corporate profit. Depending on the fund's results and classifications, a payout can include option income, gains, or return of capital. Return of capital is not automatically bad, but it can mean that part of the cash received is economically connected to the investor's own capital coming back. The label on a payment does not answer whether wealth was created. In this matchup, MSFO wins the headline yield contest and offers the more frequent schedule. MSFY wins the payout durability comparison by a wide margin. One offers a less spectacular rate with a recent payment that still bears a recognizable resemblance to its starting level. The other offers an extreme rate attached to a distribution stream that has changed radically. If the goal is dependable spending money, the stability of dollars and cents can matter more than the size of a percentage printed on a web page. Now we examine the body beneath the cash flow. Net asset value is the per-share value of the fund's portfolio after liabilities. NAV is not the same thing as an investor's total experience because it excludes the cash already distributed, but it reveals what happened to the capital still inside the vehicle. MSFY began from a launch reference price of $25.51. Its latest NAV is $16.98, producing a NAV return since inception of negative 33%. That is substantial erosion. The fund has been mailing out cash, but the remaining share value has moved materially lower. An investor who focuses only on monthly deposits could miss the shrinking base that is generating them. MSFO began from $20.20 and now has a latest NAV of $10.55. Its NAV return since inception is negative 48%. That is the weaker capital path. The latest value is close to half the launch reference, so the extreme income presentation has come with a much more severe reduction in the value left inside each share. The direct comparison is clear. MSFY held up better on NAV. A negative 33% result is not healthy simply because another fund fell further, but it is meaningfully less damaging than negative 48%. Why can this happen when Microsoft itself is the shared economic target? Because these funds are not designed to capture Microsoft's entire return. Their calls can surrender upside during strong advances, while the synthetic exposure can still participate in declines. The result can be an uncomfortable asymmetry. Limited participation in some rallies, meaningful exposure to sell-offs, and recurring distributions pulled from the strategy along the way. Sequence matters too. If the underlying rises after upside has been sold, the fund may lag the recovery needed to rebuild its capital base. If it falls before option premiums can compensate, the fund may be left working from a lower level. Future percentage gains then apply to fewer dollars. NAV erosion is not proof that every distribution was destructive, nor is a declining NAV automatically disqualifying for an income vehicle. Some investors intentionally accept capital fluctuation in exchange for current cash, but the decline has to be included in the bargain. A fund cannot be evaluated as a successful income machine merely because money exits through the distribution door. We must also inspect what remains in the room. On that examination, neither fund preserved its launch value, but MSFY suffered the less severe damage. MSFO's capital base absorbed the deeper wound. Cash distributions changed the diagnosis, so now we put the payments back into the picture. Since launch, MSFY has distributed $10.55 per share. Using the simple distribution-inclusive measure provided, its return is 8%. That turns an ugly capital-only chart into a positive all-in result. It does not erase the damaged share value, but it shows why looking only at NAV would also be incomplete. The investor did not merely hold a declining line on a screen, the investor received cash along the way. MSFO has distributed $15.47 per share. Its simple distribution-inclusive return is 29%. That is the stronger all-in result by a considerable margin. Despite the harsher capital decline and the badly weakened recent payout, the larger accumulated distributions have more than compensated under this simple calculation. This creates the central tension in the matchup. MSFY preserved more of its internal value and maintained more of its initial distribution strength. MSFO delivered the larger simple gain after counting cash, even though its remaining share value and recent income rate look much less robust. Those are not contradictory findings. They measure different parts of the experience. Totalreturn asks whether the combination of ending value and cash received left the investor ahead or behind. It is the better scorecard for wealth creation than yield alone. But this simple measure is not a personalized investor return. Real outcomes depend on purchase date, sale date, reinvestment, taxes, trading price, and what the investor did with each payment. A person who spent every distribution would experience the result differently from someone who reinvested it. A person who entered after a major decline would not share the launch investor's exact path. The figures here answer a controlled question from the launch reference, not every possible ownership story. On the all-in score, MSFO is ahead. On the quality and current condition of the components producing that score, the picture is much more complicated. The winner of the race so far is also the runner whose recent cash flow stride has deteriorated most sharply. Risk is where the smooth marketing percentages meet the roughest day on the trail. MSFY's maximum drawdown is -47%. MSFO's is -57%. Maximum drawdown measures the worst peak-to-trough decline over the observed period. It does not mean every investor personally lost that amount, but it reveals how severe the ride became for someone exposed across the wrong stretch. MSFY held up better, yet a -47% drawdown is still a brutal experience. A fund can finish with a positive distribution-inclusive result and still subject its holder to a decline large enough to test any financial plan built on calm assumptions. MSFO fell even further at -57%. That is the larger drawdown, and it sits beside the more unstable distribution trend. Those two facts together create a specific practical risk. An investor could face a deeply depressed position at the same time the weekly cash flow is much weaker than it was near the beginning. That combination matters more than either statistic in isolation. If an investor needs to sell shares during a drawdown because the distribution no longer covers expenses, the loss stops being an abstract chart event. It becomes realized capital damage. A high-income strategy can be especially hazardous when someone mistakes a variable payout for guaranteed household income and leaves no margin for cuts. MSFY presents a different but still serious concern. Its recent payment has held up much better, but its drawdown shows that relative payout stability did not produce price stability. The option premium softened neither fund enough to prevent a major decline. There is also opportunity risk. Because the calls exchange some upside for current premium, either fund may trail a powerful Microsoft advance. An investor can therefore experience two frustrations: losses when the exposure moves down and limited participation during portions of a sharp rebound. The exact outcome depends on the contracts and timing, but the structural possibility is part of the deal. Manager and implementation risk matter as well. These are actively managed derivative portfolios rather than passive baskets tracking a published index. Contract selection, expiration choices, strike positioning, collateral management, and adjustments influence the result. The shared underlying does not guarantee shared performance, as this comparison demonstrates. Then there is behavioral risk. Weekly cash can feel safer than it is because frequent deposits create the sensation of progress. Monthly cash can do the same thing on a slower clock. Investors may mentally separate the payment from the falling value that financed the overall experience. The cure is to examine the account as one system: cash received, value remaining, and the durability of future payments. MSFY has the better drawdown record and the healthier distribution trend. MSFO has the worst drawdown and the sharper reduction in recent payments. MSFO's positive all-in performance deserves credit, but its current vital signs demand more skepticism about using the launch year payout as a planning assumption. Risk here is not merely that Microsoft might fall. It is that the option structure, capital path, and distribution policy may fail to deliver the combination an investor expected. The assigned verdict for MSFY is stable with a condition. That label fits the complete record. Its simple distribution-inclusive return since launch is plus 8%, so the strategy has produced a positive all-in result. Its price and NAV alone are down 33%, which means the income came with substantial capital erosion. Its latest 4 distributions average 80% of the first 4 average, showing a payout that has weakened but remains comparatively recognizable. The condition is understanding the exchange being made. MSFY is not a substitute for owning Microsoft outright, and its monthly distribution is not guaranteed income. It is an options vehicle that converts some potential upside into current cash while leaving the investor exposed to meaningful capital loss. The record says the machine has broadly done what it promised, but only an investor who understands both sides of that sentence is reading the label correctly. The assigned verdict for MSFO is on life support. That conclusion must be equally direct. MSFO's simple distribution-inclusive return since launch is plus 29%, so this is not a story in which everything failed. The fund delivered the stronger all-in result of the pair. But its price and NAV alone are down 48%, and its latest 4 distributions average only 13% of the first 4 average. The original income experience has deteriorated so dramatically that the headline rate cannot be treated as evidence of a healthy, durable paycheck. The head-to-head result is therefore more interesting than declaring one universal champion. MSFY has been the steadier patient, less NAV damage, a shallower maximum drawdown, and much better retention of its early payout. MSFO has been the more productive but far less stable patient, more cash delivered, a higher simple total return, and much weaker current vital signs. These are different tools, and the relevant tool depends on the goal being examined. Someone studying current cash flow, capital preservation, payout consistency, and all-in return should rank those priorities before being dazzled by either headline yield. A result that worked for one launch date investor may be unsuitable for another person who needs stable spending income, stronger downside control, or fuller participation in Microsoft's upside. The decisive lesson is not that the highest yield always loses, because MSFO's all-in return prevents that lazy conclusion. It is that yield alone cannot tell you whether an income ETF is healthy. You need the complete autopsy: the mechanism, the cash actually paid, the capital left behind, the worst decline, and the direction of the recent distribution. MSFY currently earns conditional stability. MSFO remains alive because its accumulated total result is positive, but its capital and payout trends place it on life support. Neither label is a command to buy, sell, or hold. They are research diagnoses based on the supplied figures. Verify the current documents, decide which objective you are actually measuring, and keep the final decision research only. 2 quick things before you go. If this head-to-head helped you cut through the hype, hit the like button and subscribe. It is what keeps these autopsies coming. And tell us in the comments, which of these 2 would you pick and what matchup should we run next? We read everyone. Thanks for watching.